All right, great. Well, welcome everybody. Today is Friday, January 27th. This is our first all-client Zoom together of this year, and we're coming off of what ended up being a very, very exciting year. I think is the best adjective to use for to describe 2021. A lot happened in the markets, and a lot is probably still going to happen here in 2023. So the purpose of our call today is for me to give you kind of a heads up, an orientation about kind of where we sit right now in this bear market cycle that we're in. Give you some expectations for what you might see in 2023 and what we're doing in preparation for that. Also, we're going to start the meeting off today with a highlight of one of the big laws passed last year, right at the end of the year in December, called the Secure Act 2.0, which Drew is going to be taking us through some of the big highlights of. There's a lot in there, but we're just going to try and spotlight those new laws that might be most applicable to you. All right, so let's go ahead and jump into it. All right, so cancel. Okay, welcome Drew Brooks.
Hi, everybody.
Take us through some golden nuggets here.
All right. So an enhanced version of the Secure Act, known as the Secure Act 2.0, was signed into law late last year, and it's changed rules on how investors can save and withdraw from their retirement accounts. First off, effective in 2023 this year, your required minimum distribution age has increased from age 72 to age 73. And of course, you can choose to delay the first year of your RMD until the April of the following year. Effective in 2033, the RMD age will be raised to 75. So it's just continuing to be delayed, as our life expectancies, just keep increasing. So second part is increase in the qualified charitable distributions. If you're forced to take money out of your retirement accounts and also want to make significant charitable contributions, there's now enhanced ways to use your IRAs for between $10,000 and $50,000 for contributions to charity. So previously, you were only able to contribute to charity, up to the required minimum distribution amount. Now there's, ways you can push more into charity from your retirement accounts. Also changed is how Roth retirement plans are used now through work. Employees can now elect to have their company match made into Roth 401ks. Employers may now create Roth SEP IRAs or simple IRAs, though there's many factors to consider before choosing a Roth over a traditional SEP IRA. Also changing is beginning in 2024, those of you that still have old 529 plans that were for your loved ones that were not fully used may begin rolling that balance into a Roth IRA for that same beneficiary. There's a couple rules and, things that you have to pass, but it must have been established at least 15 years before being eligible to roll into a Roth. But there are now a little bit more flexibility as to how you can get some of those funds that were, earmarked for education out of there. So. Also changing is the increase in catch-up contributions you can make to your retirement plans for those that are 50 or older. The annual increase on the catch-up contribution is up to $7,500. And then beginning in 2025, you can be able to add up to $10,000 a year between the ages of 60 and 63. The last point I want to touch on regarding the Secure Act 2.0 is if you have kids or grandkids that haven't been able to afford to contribute to their company retirement plans due to having student loans to pay for, there's now going to be ways to get a matching contribution from their employer without having to contribute themselves. And that's going to be based on the amount of student loan payments you're making. This won't take effect until 2024. And there's still things there that need to be ironed out, but we're happy to speak with anyone that would like more information on that. That's it on the Secure Act 2.0, but I just wanted to touch base with all of you. As most of you know, I've been working with John on almost all of your financial planning topics and needs. I've kind of begun focusing on business owners and professionals that have fluctuating income streams and windfalls. So in addition to business owners, athletes, screenwriters, just regular employees with stock options or performance bonuses, even lawsuit settlements. It would be my pleasure to help them understand their options, around the cash flow, different, budgeting needs that might need to come into play, if most of their income doesn't come throughout the year and maybe towards the end of the year. It's just really been a nice focus for me. I grew up around my dad's small business and worked there throughout my high school and college years. I've seen how many different directions you can be pulled in as a business owner, and how easy it is to, put your time and concentration on the company rather than focus on your own financial well-being. So please let me know if there's anyone that comes to mind that could use my and John's expertise. We appreciate it.
Awesome. Thanks, Drew. Excellent job. Good stuff there. All right. Okay. So before we start talking about where we are now and where we're going, I think it's often helpful to look back about where we've come from. We're now in the 13th month of this bear market that began last year, and it's been a bit of a ride. All right, this chart's going to require some explanation, so bear with me. There's a lot here. Okay, what you're seeing in blue is the movement of the U.S. stock market since right before the COVID crash. Okay, so if we begin, in about January of 2020, before we all knew what COVID was, okay, the market had been going up for almost 12 years solid since the Great Recession. Okay, and then COVID hit, right? And you see the big drop in blue there of the U.S. stock market, and then climbing for a number of years after that. And then you see 2022, okay, the drops that we had in 2022, and then what I've been calling bouncing around the bottom, which has been going on since about the summer of last year. Okay, we're still in it. But I've also shown you in here in green something that most people don't pay attention to, which is the movement of the bond market. Okay, 2022 was really a watershed moment for the bond market. We saw drops in bonds that we've just never seen before, really unprecedented in a lot of ways. And you can see that began happening as soon as the Fed began raising interest rates early in 2022. And you can see that green line just start to drop. Now, when bonds drop, it's not quite as, dramatic or exciting, and the scale isn't as great as the stocks. But because we rely on bonds to be the stable part of your portfolio most of the time, it was a real shock to the portfolio management that we were trying to do for you. Now, what I've also shown you here in red is what a passive 60-40, 60% bond, 60% stock, 40% bond portfolio had done over the last 3 years. Okay, so this isn't our portfolio, this isn't your portfolio. This is just a static passive 60-40 portfolio, which over the last 3 years ended down, more than 1%. Really tough time for retirees to be investing. Okay. Now, in recognition of that, we've been working really hard to try and give you guys a better result. All right. And so what I've done is highlight here again over the last 3 years, some of the things we've been doing, kind of staying very high level to improve that performance for our clients. All right. Now, the first thing we did was, as many of you guys who have been with me a while know, we went into the COVID crash with what I was calling a war chest. Okay, this war chest was very conservative investments that we had built up over a couple of years, because I began to worry about, this 12-year bull market, maybe becoming inflated and dropping. Okay, so starting in 2018, we started building that war chest. And that was excellent, because once the market did crash, we had some dry powder. We had some cash and cash-like investments that we were able to use to start buying into stocks between March of 2020 and then finishing up in the first quarter of 2021. So that whole time that the market was recovering from COVID, we were buying, right? Buy low. We all know, buy low, sell high. Now, the other big move that we made in December of 2021, we started to get worried. Okay, what if the Fed starts raising interest rates next year, and we see our clients' stock portfolios and bond portfolios drop at the same time? That's going to be a real problem. So we sold a chunk of bonds in December of 2021 before the Fed started raising interest rates and moved them into structured notes. Now, not all of you ended up in structured notes, okay? I only did this for my retiree clients and my just pre-retiree clients. Those of you who still have retirement 10 plus years away, we did not do this for you because bonds don't make up a large part of your portfolio, okay? But for most of you that are my retired clients, that's what we did. Now, that was great news because we did that right before the bonds started dropping considerably, all right? That also allowed us the ability to begin buying stocks in September of last year. Okay, we shifted about 10 to 15% of your portfolio into additional stocks in September of 2022. Pretty darn close to the bottom. Okay, not like the bottom, but really, really close. And again, we saw it as a buying opportunity. Buy low, sell high, stay disciplined. Now, through these moves and other improvements that we've done in the portfolio along the way, over this 3-year period, we've been able to deliver a 2.5% after fee return to our clients invested in our growth and income portfolio, which is sort of our staple portfolio for our retirees and our pre-retirees, which is, over 3% higher than what the passive 60-40 kind of stalwart retiree portfolio had done over that period. So my team and I, we are very proud of that outperformance. It wasn't easy. It took a lot of guts. It was a rocky road along the way, but thank you to those of you who stuck with us and trusted us. And I think we've delivered some exceptional value through these just kind of disciplined, moderate moves along the way. All right, so that's a little bit about where we've come from. Now, really, to understand where we are, you have to understand inflation, okay? Because this whole economy right now is about inflation and about interest rates. So how is it that we ended up in this situation where we have high inflation and we have the Fed acting so aggressively with their interest rate movements? Okay, well, it's all about supply and demand, okay? When demand for goods is up here and the supply of goods is down here, prices go up. It's that simple. So why did we end up in a situation last year where demand was way up here and supply was way down here? Well, the story with demand is it was just too much cheap money for too long. Too low of interest rates, too much money pumped by the Fed into the economy, left in there for way too long, and that created artificially high demand. Now, with supply, it's really all about COVID. COVID destroyed the global supply chains and also really put a kink in the neck of the labor market. It's a little bit less clear exactly why the labor market is as stuck as it is, but all of you guys know because of the restaurants you go to and the stores you go to, nobody can find people to work for them, right? And so wages are going up, right? So the supply of goods is down, the demand for goods is up. That means high inflation. Okay. Now, what the Fed is trying to do is not bring down prices. Okay. They're not trying to bring prices down. Dropping prices is deflation. That's not what they want. They want low inflation. So that means prices are still going up. They're just going up slower than they have been. And in order to achieve that, they need to close the gap between supply and demand. All right. Now that can happen in two ways. You can close that gap by pushing demand down, or you can close that gap by bringing supply up. Now, the good news is both of those things have been happening at the same time. All right. Throughout 2021 and 2022, we saw improvements in the global supply chain. All right. And we continue to see improvements in the labor market, though not huge. All right. That has contributed to supply going up. Now, demand coming down has been all about the Fed. All right. What I want to show you guys here is the Fed's movement on short-term interest rates throughout the past. Okay, if we go all the way back to the 1980s when interest rates were wacky high, okay, and you guys were all getting mortgages of 17 and 18%, right? It's because short-term interest rates were around in the high teens, right? Well, every time there was a recession, the playbook became for the Fed lower interest rates. So in the 1991 recession, they lowered short-term interest rates. During the tech bubble burst, they lowered short-term interest rates. During the Great Recession, they lowered interest rates all the way to zero. They kept them at zero until they started to try and raise them going into 2019, and then COVID hit and they had to lower them all over again. Okay, this was very low interest rates for way too long. So now you can see to the very, very, very far right, the Fed dramatically increasing interest rates faster than they ever have before. Okay, and that's what we saw all last year and probably will continue to see some of this year. Now, it wasn't just about short-term interest rates. Everybody talks about short-term interest rates. The news talks about short-term interest rates. But what was different this time were the long-term interest rates. All right. So what I've shown you here is a chart of the Fed's balance sheet. All right. Now, what the Fed did for the first time ever, and they adopted this from some Federal Reserve banks that they saw doing overseas, is during the Great Recession, they started pumping cash into the economy through something called quantitative easing. It was a way of bringing down long-term interest rates at the same time that they were bringing down short-term interest rates. And they did that by pumping trillions and trillions and trillions of new dollars into the economy. All right. In the Great Recession, immediately they pumped $1 trillion into the economy in almost a single day. All right. And then throughout the next several years, they pumped an additional $3 to $4 trillion into the market. And then when COVID hit, they doubled down on that strategy, pumping another $5 trillion into the market. So we went from a pre-Great Recession, okay, where the Fed had a minuscule, $1 trillion, floating around in the economy of cash, to now at a high, they had over $9 trillion, right? So an $8 trillion increase in new dollars that had never been seen before, pumped into our economy. That combined with zero interest rates created a situation where we had too much cheap money for too long. And that's what the Fed is trying to undo. That's how they're going to push down demand, is by finally raising those short-term rates and slowly sucking that $9 trillion out of the economy. Okay, so where does that put us today? It puts us still in a bear market where we are bouncing around the bottom. Okay, this has been 7 months now, essentially, of bouncing around the bottom. All right. Now, every market cycle, okay, it has a peak, it has a trough, and then it has a recovery. Okay, and the big question is, when is the recovery coming? How long is it going to take? Right? Okay. Well, here are the statistics. Okay, when we look at market corrections, bear markets, and recessions of the past, this is how long it took for stocks to reach a new all-time high. Okay, so to fully recover, get back to the pre-drop levels. All right, corrections happen very fast. It only takes maybe 4 months on average to get back to new all-time highs. But we're way beyond correction territory. We're now in bear market and recession territory. Now, on average, we're looking at anywhere from 16 months to as long as 24 months for a bear market to hit a new all-time high. Okay, now we're 13 months in so far. So on average, we would be hitting new all-time highs 3 months from now. Okay, now I don't think that's going to happen. I don't know of many economists or market investors who think that's going to happen. But the average would say that if all this is a bear market and we don't experience a recession, that we would be looking at the next, 7 to 9 months of a recovery, of a market increase, okay? Because bear markets typically don't last longer than 24 months, all right? And we're 13 months into it, right? Okay, but the big concern this time around is this going to turn into a recession? Now, the odds are right now that it very well could. The pundits will tell you that it's probably a 60% chance. I'm a little bit more optimistic. I think it's probably closer to a 30% chance that we go into a recession. But if we do go into a recession, it is going to push back how long it will take to reach full recovery. Okay, that doesn't mean that's how long it's going to take for the recovery to begin. This is how long it will take to reach full recovery. All right. Now, in light of this, my expectations for this year is that we will not go into a recession. Okay, I have faith in the Fed, and I think the data supports it, that the Fed will start to ease their interest rate increases before the economy sinks into a recession. Now, there are parts of our economy that are suffering, okay, but there are other parts that are still very, very strong. Okay, and so even if the tech sector, for instance, which is one of which is suffering the most of our economic sectors here in the U.S., even if they end up going into a contraction phase, the rest of the economy can still support growth. All right, and we actually got some pretty good GDP numbers for the fourth quarter just this morning. And some pretty good inflation data, actually. That inflation is coming down again just this morning. Now, the Fed meets on February 1st. That's coming up on Tuesday, right? We're going to get their next decision on interest rates. And I'm gonna boldly predict that the Fed is going to increase about 0.5%, and that in their commentary, they are going to capitulate a little bit and not be so hawkish. They're going to recognize that inflation is showing signs of coming down, and that they're not going to be beating the drum of interest rate increases the rest of this year to the extent that they were last year. I'm expecting them to slow down, to be a little patient, to allow the interest rate increases that have already gone into effect continue to bring down inflation, and thus not pushing us into a recession. All right, so that kind of begs the question, so what do you do if you're sitting on cash right now? Okay, now we've had this conversation in the past. We talked about this all last year, okay, but things change. So I want to remind you again what my advice around cash is right now. If you're sitting on cash, you need to think about your cash in terms of what cash do you need for your emergency fund? What cash do you need for your short-term goals? What cash do you need for your long-term savings, right? And we can help you with this type of analysis. This is usually the first place we start together, all right? Now, once you've determined how much cash you need for each of those buckets, then it comes time to figure out what the best strategy is to invest each of those buckets of cash. Now, your emergency fund needs to be staying in FDIC insured savings and money market accounts. For your short-term goals, I still like the I bonds. Okay, now there's some restrictions around that. I'll talk about it in a second. But many of you took my advice last year and bought some I bonds and have been getting nice guaranteed government-backed returns on that money. Okay, but for your long-term savings, still the best buy, the best investment is your Village Wealth Advisors investment portfolio. That's where you're going to get the most growth on that cash that you don't need for your emergency fund or your short-term goals. Okay, but we do have some suggestions here. Okay, for your savings and your money market investments for those emergency funds, right now, Capital One is paying on their FDIC insured savings account about 3.3%. Okay, that's among the highest I've seen out there. Okay, the major banks stink right now. Okay, the major banks aren't paying anything. Wells, B of A, Citigroup, all of them. They're all paying like 1% still. They're basically getting away with murder by paying you nothing on your savings. Okay, so you can get an FDIC insured Capital One savings account paying 3.3%. I love that. Okay, I've also been talking to a lot of you guys about our non-FDIC insured Schwab Money Market Fund paying 4.25%. Fully liquid. Okay, no principal fluctuation. It is not FDIC insured, so you need to weigh that. But 4.25% is really nice on short-term emergency fund type money. The Series I bond, I'll just remind you, right now it's paying 6.9% for any I bonds purchased now through April 30th. Okay, it is kind of a pain though. You got to go through treasurydirect.gov and you can only buy $15,000 per year of those bonds. Okay, they have a 1-year holding period. And then if you sell them before 2 years, you got to give up a little bit of interest, but still they're perfect for short-term need to stay safe goals. Okay. And again, for your long-term money, your Village Wealth Advisors investment portfolio, still your best long-term return. And this is still good timing. Okay. It's not as perfect as it was the last time I told you to get in, but this is still very good timing. We are still absolutely bouncing around the bottom. We are not in the recovery yet. And this is the time to be buying low. Okay. All right. So what are my thoughts and predictions? Okay. This is always a moment of faith here when I stare into my crystal ball and deliver to you my my greatest predictions for the future, right? Okay, so what are we going to see in 2023? Okay, I do think we're going to begin to see a market recovery in 2023. It's going to start this year. Once it starts, you're going to see a 15 to 20% upside in your portfolio, but it's probably going to take up to 2 years to happen. All right. Now we're going to see that 0.5 point increase from the Fed on February 1st, but they're going to telegraph that future rate hikes are going to be fewer and slower. Okay. Though we are going to continue to see long-term bond yields increase as the yield curve flattens out. Right now it's inverted. Right now, long-term rates are less than short-term rates. So we want to see that flatten out. Okay, and that will continue to happen, along with inflation continuing to slow. Now, I want to just kind of pat myself on the back and take a moment of pride here. You know, my last prediction when we met on October 11th and we did this all client Zoom, I told you that in Q4 we would continue to bounce around the bottom, but we were going to see a pop in the market. I was predicting about a 5% pop. In truth, we actually got a 10% pop in Q4, okay? And so all of that buying that we did in September really paid off, and at least that prediction was on the money. Okay, now the last thing I want to do, that's kind of the end of my market talk. Village Wealth Advisors had a big year last year, and it was a very exciting year for all of us professionally and personally. And I just kind of want to share some of that excitement with you guys. First is we expanded our team. This is now your Village Wealth Advisors team. You've got Drew and I in the back there. We've got Naivi in the middle, who has been working with me for 12 years now. But we were very excited last year to add Delilah and Nicole to our team. I'm sure many of you have heard from them, have spoken with them. They've been doing amazing work here, just taking our team to new highs, and we're very excited to have them. Also on the personal front, we had 2 babies born last year. Naive's little baby Ezra on the left there is now about 3 months old. And then my little baby girl Hannah on the right turns 3 months old tomorrow. So our little Village Wealth Advisors family is expanding in a lot of different ways. And then finally, I just want to thank all of you guys who voted and who expressed your faith in us. Village Wealth Advisors was awarded Best Financial Planning Firm in Ventura County by the Ventura County Star for last year. So we beat out the likes of Fidelity and Edward Jones and can't remember who else was on that list, but some of the really big boys. And I really appreciate all of you guys. I'm very excited. I'm very proud of my team. That was a huge accomplishment. All right, so I'm going to go ahead and end those pre-prepared remarks, and I'll open it up to any questions that you guys have. Go ahead and unmute yourself when you want to. Yes.
Hey, Barry here.
Hey, Barry.
First of all, congratulations and great work.
Thank you.
As you know, my position has changed, and I think I'll make the appointment now. We need to talk on Monday because I have to obviously take some of the money and do that divvying up just like you did on that chart. I think that's exactly how I want to play it. So I'd like to do that, and just call me on Monday.
Great. We'll get you on the calendar, Barry. Sounds good.
All right. Good work, partner.
Other questions or comments? Yeah, Fran. Go ahead and unmute yourself, Fran.
Here we go. Sorry, I'm just not camera ready today, John. At any rate, without getting too political, John, what do you see as a worst case scenario if this whole business about the debt ceiling comes to a bad end? What's going to happen to us as investors?
You know, I'm glad you asked about it because I know it's on people's minds. I don't even mention it because it's not going to happen. Okay, that we're not going to default on our debt. It's not going to happen. You know, I think some in Congress are a little confused about the difference between the debt ceiling and a government shutdown. Okay, a government shutdown is where Congress does not approve a budget, and it forces the government to shut down because they haven't approved a budget, right? The debt ceiling is a completely different issue. This is for expenditures that Congress has already voted to spend the money on. The president has already signed into law, whether it's this president or the previous president or the president before that. This is all spending that's already been fully authorized. And so it's a silly issue that pops up every 2 years that causes a bunch of commotion, and the market didn't even bat an eye when you know that we hit the debt ceiling and the Treasury had to start doing these I can't remember what they called it, but extreme measures to keep the government funded. I mean, worst case scenario is the U.S. government defaults on its debt, and that would be really, really, really horrible. But I think it's such a small likelihood of happening, it doesn't even figure into my strategy.
Okay, thank you, John.
Yeah. Other questions? Okay, great. Well, please feel free to reach out to us.
I do.
Yeah, okay.
Sorry, real quick. My question popped in my mind, and again, it's long-term future stuff. What do you think the whole electric car push by the government is going to do? Because isn't a lot of our economy based on oil and stuff? And with this push, is it affecting us now? Will it? Blah. What do you think?
No, it's a good question. I mean, the thing about electric cars and about any new technology is it is disruptive to existing industries. It always has been, right? The tech bubble of 1990 was disruptive to a lot of brick and mortar businesses, and that caused some businesses to go out of business as it made room for other businesses to emerge and flourish. And that's sort of the healthy part of capitalism, is that we have a very flexible system. We can still grow, and businesses can continue to flourish even as others die out. Now, if that ends up being the case with with the automobile industry, then that's possible. But I think what we've seen is a lot of the existing automobile industries pivoting and really adapting and trying to become leaders in that market also. Now, when it comes to oil, I mean, I don't think we're going to stop using oil anytime soon. Oil is a chunk of the U.S. economy, but again, I think we're adaptive enough where as jobs are lost in one spot, they can be picked up in another. For instance, I think I've seen 10 homes in my neighborhood put up solar power cells, just in the past year. It will be difficult for some workers to retrain as they have to adapt to new industries, but it doesn't mean the economy overall won't continue to flourish.
Great, thank you.
Sure. Other questions?
Hi, this is Ken.
Hey, Ken.
I had a question about money market funds. There are different types of funds, and they have different tax implications. What are your recommendations there?
Yeah, so in general, for most of my clients, I recommend the straight up taxable money market funds. Okay, the same thing you would get if you opened a Capital One savings account. Okay, all of the interest paid on that is going to be fully taxable. Okay, you'll pay ordinary income tax rates on it. The Schwab money market fund that I was quoting there at 4.25%, that is a fully taxable fund. Okay. Now, for those of my clients at the very top tax brackets, we can do an analysis to see whether the tax-free money markets are a good enough value. Okay. You essentially just need to take the marginal tax rate, apply it to 4.25%. And if the tax-free is willing to pay higher than that, then it's a good deal. But for most of my clients, it's still going to be the best deal to just end up with a fully taxable money market right now.
Okay, thanks.
Yeah, no problem.
Yeah, John, I got a question. This is Steve.
Hey, Steve.
Yeah, it's I guess maybe it's for Drew. Would it be a smart thing to convert some of the holdings in the 401k to a Roth and therefore not pay any income taxes, or capital gain taxes on any distributions from that Roth?
Am I unmuted here? Okay.
No, you're spotlighted and not muted.
Yeah, Steve. So what I understood from your question is if you think you should start converting maybe a traditional retirement account to a Roth, so you don't have to worry about the income taxes throughout the rest of your life via distributions. Is that correct?
That's correct, Drew.
Okay, so yeah, we can talk about this more in depth, offline, but as you convert your traditional IRA to the Roth, there will be income tax consequences, and you can't technically do a part of your traditional IRA without paying taxes on the proportional amount of all of your retirement accounts. So there is some planning involved, but yes, you have to pay some sort of taxes at some point.
Yeah, honestly, Steve, for most of my clients, over the age of 55 or so, I usually discourage it. You really need a long time to make these Roth conversions worthwhile. So I'm usually not too hot on it. Plus, it's just really painful. You got to write a huge tax check.
Yeah, noted. Yeah, definitely. Okay, thank you for answering the question.
Absolutely.
Hey, John, I have a quick question. On the Schwab's 4.25% short-term investment, does the funds have to be in the account for a certain period of time?
Great question. No, it's fully liquid. There's no lock.
Oh, beautiful.
Move it in, move it out.
Okay, great. Okay, and how do I set that up? I just call, I mean, can I set it up through you guys?
Yep. Just give
Okay.
us a ring and we'll get it
Okay.
set up for
Great.
you. That's
Great.
really
Thank
easy.
you very much.
My
And the same
pleasure.
is the case with Capital One also? You can withdraw anytime you want?
Yeah, so the Capital One account, I have nothing to do with, but based on
Okay.
what I read,
Okay.
there are no lockups for that account, but
Got
please check it out yourself, make sure they're
I
not
will.
trying to pull a fast
Okay.
one. But
Great. Thank you very much. Thank you, John.
Yep, no problem.
Yeah, I have my money in Capital One. It's just like a savings account. You just put it in, take it out. It's very easy peasy.
Yep. Thanks, Colette. All right. Well, hey, thank you so much, everybody, for attending. I know we went a little longer than anticipated. Sorry for that. I will be sending out the recording of this video shortly. Please forward it to anybody that you think could benefit from this information. Anybody who's feeling nervous, who's feeling lost, who doesn't know what to do with their money right now, or just may need a second opinion. We love talking to prospective clients who just want to bounce some ideas off of somebody. And as you guys know, our style is very, very consultative, right? We're not looking to pressure anybody into anything. So again, thank you so much, all of you guys, for your time, for your attendance, and look forward to seeing you again soon. Take care.
Thank you, John.
Thank you, John.
Good job.
Thank you.